Welcome back, America, to Sound Retirement Radio, where we bring you concepts, ideas, and strategies designed to help you achieve clarity, confidence, and freedom as you prepare for and transition through retirement. And now, here is your host, Jason Parker.
America, welcome back to another round of Sound Retirement Radio. You're listening to episode number 395. The title is The Secure Act 2.0, The Changes You Need to Know. I feel like a poet and didn't even know it. Anyways, as we get started today, let's get the morning started right by renewing our mind. I've got a verse here for us from 2 Timothy 2, verses 23. Don't have anything to do with foolish and stupid arguments, because you know they produce quarrels. How can you help a starving cannibal? Give him a hand. What's the definition of a slug? A snail with a housing problem. I'm very pleased to announce that we recently did a complete overhaul to the look and the feel of the retirement budget calculator, and it looks so much better. If you get a minute, go visit retirementbudgetcalculator.com, and if you're part of the premium service, be sure to log into the community and let me know what you think about all the changes. As we ring in the new year, it's a good time to review the rules for the required minimum distributions. RMDs are an important part of retirement planning, and understanding the requirements can help you make the most of your retirement cash flow strategy. In today's podcast, I'm going to give you an overview not only of how the RMDs have changed again, but also a few of the other changes that were brought about as a result of the new Secure Act 2.0 that was signed into law on December 29th, 2022. Many of you know that within the retirement budget calculator, we include the calculations for estimating your required minimum distributions. And we're going to be updating the code within the calculator in the very near future to help take the mystery out of these new RMD rules. Remember, articles, links, and resources mentioned in today's podcast can be found at soundretirementplanning.com. Just visit there and click on episode number 395. For those of you who have subscribed to the premium version of the retirement budget calculator, we posted a checklist of important items for you to consider, and that's in the community portal within the calculator. We're going to be talking about all these new rules and laws that pertain to the Secure Act 2.0, so let's start out with a couple of fun quotes about taxes. Benjamin Franklin says, "The only things certain in life are death and taxes." Mark Twain says, "The only difference between a taxman and a taxidermist is that the taxidermist leaves the skin." It's a good thing we don't get as much government as we pay for, says Will Rogers. I'm proud to be paying taxes in the United States. The only thing is, I could be just as proud for half the money. Arthur Godfrey. Milton Friedman says, "Congress can raise taxes because it can persuade a sizable fraction of the populace that somebody else will pay. Death and taxes are both certain, but death doesn't get worse every year." And then, of course, Albert Einstein says, "The hardest thing in the world to understand is the income tax." As the new year arrives, updated regulations stipulated by the Secure Act 2.0 have altered the nature of the required minimum distributions for many retirement account holders. Under Secure Act 2.0, individuals born between 1951 and 1959 can wait now until age 73 before they have to take their RMDs instead of the previously mandated age of 72. For those of us born after 1960, we don't have to take our first required minimum distribution until age 75. Keep in mind that if you fail to take required minimum distributions, there are penalties, and the new law will reduce the penalty for not taking your RMD in a timely fashion from 50% to only 25%, and potentially as low as 10% when corrected in a timely fashion. And I'm going to talk more about these penalties in just a minute. If you turned age 72 in 2022, you are still required to take your first required minimum distribution for 2022. If you did not take the first RMD in 2022, you have until April 1st of 2023 to take your first RMD, but you will end up needing to take 2 RMDs in 2023. If you had turned 70 and a half before the year 2020, you were already started taking your RMDs and nothing changed. You're going to continue taking those RMDs. When it comes to RMDs in 2024 and beyond, widows and widowers are going to have a new option to choose from after the death of their spouse. And this new option says that a surviving spouse can be treated as the deceased spouse. And this option is going to be especially important when there's a big difference in ages between spouses, and especially when the deceased spouse was the younger of the two. So let's say Mr. and Mrs. Jones, we'll say Mr. Jones is 70 years old and Mrs. Jones is age 60 in this scenario. And we're going to assume that Mrs. Jones, who's 60 years old, dies first. If Mr. and Mrs. Jones were similar in age, it would be common to see Mr. Jones just treat her IRA as his own, roll it into his account, and start RMDs when he turns 73. But this new provision allows him to be treated as Mrs. Jones, and because she is 10 years younger and only age 60 when she died, he would be able to wait 13 years before having to take an RMD because it would be based on when she turned 73 rather than the RMD in just 3 years if he had inherited the IRA and moved the money into his own IRA. Not only does he get to postpone taking the RMD until she would have turned 73, but then because the RMD is based on her age, the percentage that he'll have to take at her age 73 is less than the percentage that he would have to take at his age 83. Another provision of the Secure Act 2.0 is that you're no longer forced to take an RMD from your employer Roth plans starting in 2024. Some of you may know that RMDs were not required from a Roth IRA, but if you had something like a Roth 401k or a Roth TSP, you were required to take minimum distributions under the old rules. The new Secure Act 2.0 eliminates this additional RMD on qualified employer Roth plans, but that doesn't go in effect until 2024. So let's circle back around to those penalties. We talked about the fact that the penalty is dropping from 50% to 25% and possibly as low as 10%. There have been a handful of times over the years when one of our clients missed taking their RMD before the December 31st deadline. And I remember the first time this happened, it was very alarming because it was a $40,000 required minimum distribution, and missing that RMD would have resulted in a $20,000 penalty. The client had ended up in the hospital, and that's the reason that he missed that particular RMD. So what we did was we wrote a letter to the IRS, we explained the situation, and we filed Form 5329. And the IRS waived the penalty, and the client just had to take 2 RMDs that year to fix the mistake. In the handful of times that one of our clients missed an RMD, the IRS did not impose the 50% penalty. In every instance, we wrote a letter, we explained what happened, and we filed Form 5329. Well, the new rules say that the penalty will drop from 50% to only 25%. And if you correct it in a timely fashion, it will only be a 10% penalty. So in the handful of times where I've run into this in the past, there was no penalty. But now there's going to be this 10% catch-all when corrected in a timely fashion. I have a feeling this is going to generate more penalty revenue from missed RMDs than the previous rules did. RMDs can be an important part of a retirement cash flow plan. Retiring early, say at age 60, usually means a decrease in taxable income. But understanding which accounts you're going to be withdrawing from and when to start things like Social Security and pensions can open up the possibility of Roth conversions before having to withdraw RMDs at age 73 or 75. Looking at doing conversions from a traditional IRA to a Roth IRA could be a smart strategy for some people. If you retire at 60, one thing to be mindful of is that the Affordable Care Act subsidy that helped reduce the amount of money you pay for health insurance before age 65 can be impacted by doing Roth conversions. There's a lot of moving parts with these strategies, so make sure you're thinking through all of the implications before you make any changes. Fortunately, newly implemented RMD regulations do not modify the age at which you're eligible for qualified charitable distributions. If you're charitably inclined, you can still begin giving from your IRA using the QCD, Qualified Charitable Distribution, at age 70 and a half. And you don't have to wait until age 73, which is the new RMD age for those born between 1951 and 1959. Many people today are unable to capture their charitable giving on their tax return because the standard deduction is so high that most people don't give enough to be able to itemize and overcome the standard deduction. So giving your RMD directly from your IRA to your charity helps eliminate the RMD income from hitting your tax return. Less income can have multiple effects on other areas of your taxes, such as how much of your Social Security income is taxable, how much you pay for Medicare premiums, or how much of your medical expenses you might be able to deduct and itemize. Many people don't understand the value of giving using the QCD, Qualified Charitable Distribution. And I found that the best way to understand the benefits is by using tax planning software to model this option and show people how it would work for their specific situation. So speak with your CPA to determine if a qualified charitable distribution would be beneficial for your specific situation. Beginning in 2023, the new law offers a one-time opportunity to give up to $50,000 as a QCD to an expanded variety of charities, such as a charitable remainder unit trust, a charitable remainder annuity trust, and even charitable gift annuities. And this represents an opportunity for individuals looking for ways to give to charity and collect a steady stream of income from their retirement account assets. In 2022, if you had a Roth 401k at work and you received a matching contribution from your employer, the way that it worked was that your contribution went into the Roth portion of your account and your employer contribution was allocated to the traditional pre-tax, tax-deferred portion of your 401k. Well, effective immediately, your employer's matching contributions can now be added to the Roth tax-free portion of your 401k. Of course, doing this will create additional income for you in the year of the employer contribution. At my firm, at Parker Financial, we have a 401k and a Roth 401k available to our team. And I contacted my 401k administrator to see if we could make this change and have the employer contributions added to my Roth rather than to the pre-tax, tax-deferred account. My 401k provider said that they're reviewing the new rules and that this is not yet possible within the structure of my Roth 401k. So just because the law makes it available doesn't mean your 401k provider has made it available yet. In 2014, QLACs became available. A QLAC is an acronym for a Qualified Longevity Annuity Contract. The idea with a QLAC is to have some of your IRA money allocated to a deferred annuity to help protect against you running out of money in your old age. Before the Secure Act 2.0 was law, you could use 25% of your IRA account balance up to a maximum of $145,000, whichever was less, to purchase a QLAC. But the new Secure Act 2.0 eliminates the 25% of the account balance limitation and increases the amount that can be used to purchase a QLAC from $145,000 up to $200,000. A QLAC provides a few benefits, including guaranteed income for life, no matter how long you live. It avoids market risks, and it allows you to delay required minimum distributions on the assets that are in the QLAC until age 85. So, for example, if you move $200,000 into a QLAC, you don't have to take an RMD on that $200,000 when you turn 73, but a QLAC does require that you start income at age 85. One of the things I'm most excited about, in 2024, some people who have 529 plans are going to be able to transfer money from their 529 plan into a Roth IRA as long as it's for the benefit of the 529 plan beneficiary. There's all kinds of rules around this, such as the 529 plan had to be open for 15 years or longer, contributions made, and the earnings from those contributions in the last 5 years are not eligible for transfer, and Roth IRA contribution limits will still be in effect. So, for example, let's say the Roth contribution limits stay the same in 2024 as they currently are in 2023. The Roth IRA contribution limit for someone under the age of 50 is $6,500. If the 529 beneficiaries are working and contributed, say, $3,000 to a Roth IRA, they would be only able to transfer an additional $3,500 from the 529 plan, assuming that they qualify, to the Roth. For kids who receive scholarships and did not use all the 529 funds for college, this creates a really exciting way to help them get a head start on their tax-free retirement savings. I used to tell people, well, just keep the 529 plan in place and you can change the beneficiaries in the future and use that money for your grandkids' education. But this now gives us the opportunity to get money into those Roth IRA accounts. The most that you're going to be able to convert from your 529 to a Roth is $35,000 over an individual's lifetime. It's likely that we're going to be sticking our kids with a huge future tax bill thanks to our deficit spending and the $31 trillion of national debt. It's hard to imagine that taxes won't go up at some point. So the least we could do is help them get a little tax-free money set aside for retirement. So let's say from age 16 until age 22, you're able to transfer $6,500 from your 529 to the Roth for the benefit of your student. At age 22, you will have maxed out the $35,000 contribution limit. So then at this point, let's say the student takes that $35,000 that's in the Roth and they invest it, and it grows, it compounds and grows, and they're able to earn 9% per year for the next 43 years until they reach age 65. They'd have $1.4 million of tax-free money for retirement. If their investment account compounds at 8% per year, they'd have $957,000 for retirement. If the kids are fearful about the future and they keep all of their money in a savings account that earns 3% per year, they would have $124,000. $1.4 million versus $124,000. I guess there are real-life consequences for playing it too safe. Time is the cure to the volatility of the stock market. These young people, they've got a lot of time on their side. This is not the time that they need to be playing it safe. In summary, when there are changes, there are often opportunities to capture them. Opportunities are more easily captured by those who are prepared for them and are paying attention. Seneca once said, "Luck is what happens when preparation meets opportunity." One of the difficult things about the new Secure Act 2.0 is that not all of the provisions are effective immediately. Some of the new legislation is effective immediately, and some of it will get phased in over time. I only covered a small snippet of the changes that were included in this new law, and I tried to focus on the items that will have the biggest impact for those of you in or approaching retirement. If you want to explore these topics in greater detail, visit soundretirementplanning.com and click on episode 395. I've got a lot of great links to articles and some other resources for you to review.
Information and opinions expressed here are believed to be accurate and complete, for general information only, and should not be construed as specific tax, legal, or financial advice for any individual, and does not constitute a solicitation for any securities or insurance products. Please consult with your financial professional before taking action on anything discussed in this program. Parker Financial, its representatives, or its affiliates have no liability for investment decisions or other actions taken or made by you based on the information provided in this program. All insurance-related discussions are subject to the claims-paying ability of the company. Investing involves risk. Jason Parker is the president of Parker Financial, an independent fee-based wealth management firm located at 9057 Washington Avenue Northwest, Silverdale, Washington. For additional information, call 1-800-514-5046 or visit us online at soundretirementplanning.com.